What is up, everybody? Happy Monday, and welcome back to the Everything Crypto Show, where we keep you up to speed on the most important news moving the crypto markets. Now, we are back today with another very important daily market update as another FUD campaign has hit Binance, and this time Forbes is claiming that they shoveled around assets eerily similar to maneuvers made by FTX before the collapse of that exchange. What is being claimed in the article is that Binance left $1.8 billion worth of USDC uncollateralized here on their balance sheet, and we're going to break down using some on-chain data to determine whether or not this is in fact true or just another piece of baloney from mainstream media. Then we do have Silvergate, who did actually announce that they were concerned about their issue to continue operating this previous week. Their stock crashed over 50%, and then on March 3rd, they announced that they were discontinuing the Silvergate exchange network. And this is a very big deal, as this is the network that enables their digital currency and institutional investor clients to actually send USD to and from their Silvergate accounts and accounts of other Silvergate clients. And after this statement, we saw Bybit, one of the largest crypto exchanges in the world, actually halt deposits via their USD bank transfers. So lots of stuff happening right now with centralized exchanges that you do need to be aware of, and we're going to break all that down in this video. So without further ado, it is time to sit back, relax, grab that morning cup of joe, and enjoy the show. Now make sure to hit that sub, like, and notification bell and join the Everything Crypto Squad. And with that, we're going to hop right in here with the question of the day. And today I want to know, do you have any of your crypto on a centralized exchange? If so, let me know in the YouTube comments down below. And I'll just say right off the bat, if you do, please consider looking into a cold storage wallet. Now with that, we're going to hop right in here with the Bitcoin chart, still range bound in between $20,000 and $25,000, which I have identified as the biggest level of support and resistance to look for on the chart in the coming weeks. 25K here, very simply, because that is where the 200-week moving average is sitting. And we saw here that for the weekly candle closing on February 13th, as well as the one closing here on the 20th, that Bitcoin did in fact fail to break above this level on two different weekly candles. We had a fake out above it, but both of these candles did close below it. So even before the collapse of Silvergate Bank that we covered last week, we were calling for Bitcoin to actually make its way back down to 20,000 based on the technicals. And I think some of the news that we did see this previous week is just kind of speeding up the process of Bitcoin making its way back down to this level. In fact, if we go all the way here back to August, after we saw Bitcoin capitulate in June, you're going to notice that on the candle closing on August 8th, as well as the weekly candle closing on the 15th of that same month, we did see Bitcoin get rejected twice at the $25,000 level. Now that has happened here once again with a nice double top on the weekly candles at 25K. But more importantly, in my opinion, this has also coincided with a rejection at the 200-week moving average. And to gain a bit of an understanding as to why the 200-week MA is such a serious area for Bitcoin to actually break above, I'm going to go ahead and pull up the 200-week moving average here for you guys. I have showed you this before on the channel, but it does really paint a clear picture for why the 200-week MA is such a key technical area for Bitcoin. So it is represented here by the blue line, and you can see that historically speaking, this technical indicator has acted as a very strong level of support and buying opportunity for Bitcoin. In 2011, Bitcoin bounced off it around the, let's say $2.50 level and rallied all the way up here in 2013 up to just over $1,000. Then in 2015, once again bouncing off it and give or take the mid $200 range, running up to that $20,000 area in 2018. Once again in 2019, bouncing off it in around the mid, let's say $3,500 range, running all the way up to $14K in 2019. And then once again in 2020 on the flash crash, coming down to about the mid $5,000 range and running up to the previous bull run all-time high of $69,000. This does make the first bear market that Bitcoin has broken below the 200-week MA and spent a sustained period of time below it. Therefore, it did make the most sense to me that this would act as a strong level of resistance moving forward, and that is why until we see a breakout above the 200-week MA, I am not considering the crypto market to be bullish whatsoever, even with the nice rally that we have seen year to date. And also, Bitcoin is getting rejected at the 50-week moving average, which is the green line there, which is important to keep in mind, as that is also where Ethereum is being rejected. So the difference between Bitcoin and Ether at the moment is that Ether is actually above the 200-week MA but below the 50-week, while Bitcoin is below both of these levels. But that does not change the fact that both of them are getting rejected at the 50-week moving average. We can see here that Bitcoin got rejected at the 50-week MA in March of last year and has not made a move back above it since. And similarly with Ethereum, which got rejected at it here in March as well as early April and has not made a move back there since. So the 200-week MA is more important for Bitcoin, but speaking in like the broader context of crypto, I think the 50-week moving average is what we do want to keep our eye on more so at the moment. And the fact that the 200-week MA for Ether actually sits at 1423 leads me to believe that it also wants to make a revisit of its 2018 all-time high at 1400. So that is what I'm looking for when it does come to the charts. And now I do want to show you guys some on-chain data that indicates that even as we did kind of enter this previous bull run, that we saw an inverse correlation between the price going up and the amount of Bitcoin and Ether leaving exchanges. So as of right now, this date is lined up with March 4th, and you could say, I mean, this is pretty much when the flash crash happened that I don't think many people saw coming, and then this did lead us into the next bull run here where Bitcoin did top out at 69K, and what you're going to notice is that when we actually saw this begin, we saw exchange reserves for Bitcoin. It was started at 3 million in March of 2020, okay? It ran all the way up here to about 3.1 million as people were moving their Bitcoin back onto exchanges to sell it, and since then, the amount of Bitcoin over the past 3 years has been reduced from 3 million, just over 3 million, down to 2.1 million, just under a 33% decline in the amount of Bitcoin being held on the centralized exchanges. And as for Ethereum, the actual amount of ETH leaving exchanges has been even more impressive here, as at the beginning of March 2020, it had an exchange reserve of about 32.8 million Ether being held on the centralized entities, now down to 18 million, so over a 33% decline in the amount of Ether held on the centralized exchanges. Actually almost closer to 50% decline, right? Like going from 32.8 million down to 18.2 million. I believe that's even over a 40% decline in the amount of Ether leaving centralized exchanges. And this does come at a time as we are seeing Bitcoin leave these centralized entities that we've also seen the amount of Bitcoin being held here simply just increasing over the past couple of years. So let's date back to March of 2020, and we're going to notice here that the 1 year hold away, so the amount of Bitcoin that had not moved in over a year, was at 58.97%. That is now sitting at all-time high territory of 67.87%. So not only is the amount of Bitcoin on exchanges hitting new lows, but the amount of people holding their Bitcoin is hitting new highs. And same thing goes for Ethereum. As we have seen Ether leave exchanges, we've also seen a massive boom of Ether into these liquid staking solutions where people can't actually earn yield on their Ethereum. So here is Alito Finance. Since it did begin back in 2020, it had a TVL of about 2.5k Ethereum. That is now all the way up here at 5.69 million Ether. We can also go ahead and take a look at something else like Rocket Pool. Now, we're not going to talk about Coinbase because that obviously is a centralized version of Ether liquid staking. We've also seen Rocket Pool here go up since it actually was created back in 2021. This was November of 2021. It had 172 Ether being held in its liquid staking solution, and that is now up to 620,000 Ethereum. So an inverse correlation here between the price of Bitcoin and Ethereum, as well as the amount of Bitcoin and Ether leaving exchanges. And not only that, but also between this leaving exchanges and the Bitcoin being held over longer periods of time, and Ether being used to generate that yield, showing you that more and more people are beginning to see the importance of self-custody of your assets, as well as what DeFi does have to offer for Ethereum through the staking solutions to actually generate that passive income. Now, as we have sort of talked about centralized exchanges here and Bitcoin and Ether leaving it at a rapid pace, I do want to get into the meat of this video, the very important news. Now, on Saturday, we covered how the SEC blocked the Binance acquisition of Voyager Digital deal. This was a deal that would actually have Binance acquire Voyager and make customers whole again. This would allow creditors to see a 73% recovery rate, and 97% of customers voted in its favor, and they're now objecting to this deal. It has not been completely blocked yet, but the SEC does not want this deal to go through on the basis that VGX token could in fact be a registered security. And keep this in mind because we actually also did see the SEC staff or somebody on their staff also claimed that they believe Binance US to be running an unregistered securities exchange as well. But first, I do want to hop into this news that we saw from Forbes Digital Assets. So they say here that the world's biggest cryptocurrency exchange quietly moved $1.8 billion of collateral meant to back its customer stablecoins, putting these assets into other undisclosed uses. They did this without informing their customers, according to blockchain data examined by Forbes from August 17th to early December. About the same time FTX was imploding, holders of more than 1 billion of crypto known as Btc USDC tokens were left with no collateral for instruments that Binance claimed would be 100% backed by whichever token they were pegged to. And Btc USDC tokens are digital replicas of USDC, which is a dollar-pegged stablecoin issued by Circle Financial. So here is the chart, the infographic that they are using, saying that 1.8 billion of USDC that was collateralized BUSDC tokens was liquidated and shuffled to various counterparties, then quietly replaced over several months. Funds are Seifu, which is something that CZ tweets all the time, has been a red herring all along in case that wasn't already clear. There was a gaping $1.8 billion hole in Binance's balance sheet where there should have been USDC collateral. By the way, it has over 90 other B tokens that it issues and collateralizes with the underlying crypto, all of which are susceptible to the same rehypothecation. And yeah, he just goes on to talk about how basically Binance was shuffling around users' funds, and we can actually zoom in here, and it says that Binance breaks its own rules of 100% B tokens collateralization by taking 3.63 B peg to 2 B token investor classes, deposited those tokens into Binance 8, a cold storage wallet. 7 days after it took 1.8 billion in BUSD tokens, Binance returns them to the peg wallet, and it says here basically they were taking this BUSD or USDC and sending it to wallets such as Justin Sun, Amber Group, Alameda Research, Cumberland. So they effectively use this sort of infographic and make it appear as on-chain data that proves that Binance was shuffling money that was supposed to be collateralized around to some of their clients and cold storage wallets. And we saw CZ once again take to Twitter to address some FUD that was made by the mainstream media effectively, as there has been a lot of that lately. So he says here, I am reluctantly spending time on FUD again. Forbes wrote another FUD article with lots of accusatory questions, with negative spins, intentionally misconstruing facts. They refer to some old blockchain transactions that our clients have done. They called out Tron, Amber Group, Alameda Research, etc. They seem to not understand the basics of how an exchange works. Our users are free to withdraw their assets anytime they want. Their withdrawals are turned into received hundreds of millions of shifted collateral. Our users also must deposit to Binance first to be able to withdraw, which are also easily traceable on the blockchain. This article conveniently ignores the deposit transactions and only shows the withdrawal transactions that took place. They try hard to categorize Binance and FTX together, including the choice of the article title, We Are Very Different. He says here, Binance has stood the test of time with users safely withdrawing billions of dollars in December. I was hanging out socially with crypto friends visiting Dubai that week, including some people there. We implemented proof of reserves, including a new zero-knowledge approach suggested by Vitalik, protecting our user security and privacy. Binance hold users' funds 1-to-1 always, and my ethnicity is brought up again as if that mattered. I am deeply disappointed that Forbes continues to write baseless articles, losing their own credibility. So addressing the facts straight up and saying that no, this was not Binance having tokens uncollateralized, and that Forbes conveniently only showed the withdrawals and did not show the deposits that also occurred. Not only is Forbes after Binance, we also saw that an SEC staff person says they believe Binance US to be operating as an unregistered securities exchange. So he believes Binance US is operating an unregistered securities exchange in the United States. A lawyer said during a Voyager Digital bankruptcy hearing on Friday, this would be the same meeting where they did object to Binance US actually acquiring Voyager Digital. The commission has not made any determination on either of these issues, and staff believes do not represent the position of the entire commission, but the comments come as the SEC ramps up its crypto enforcement activity, including settling with crypto exchange Kraken over its staking service last month and proposing tighter rules for crypto custodians. Representatives for Binance and Binance US did not immediately comment. And now we have Judge Michael Wiles weighing whether to approve the proposed sale of Voyager assets to Binance US. The SEC has objected to the sale, and the bankruptcy lawyer actually said that this was a little bit ridiculous. He says this is a public court proceeding, anything that further explains the basis for the SEC's position, that seems to me is something everybody is entitled to hear, as clearly they don't have any sort of regulatory clarity. And Wiles said that he still did not have very much clarity because the commission did not take an official position. They've simply called it a securities exchange without actually giving any sort of reason for why this may be. And you know why there's no reason? Because they have not made any sort of clear laws or guidelines for these crypto exchanges to operate in the US. So the SEC is trying to make it sound like they want to protect customers, but at the same time, they are blocking an acquisition that would return millions of dollars back to people who have had their money locked up on Voyager. And on top of that, we've also seen a lot of shady behavior from people at the SEC and their relationship with Sam Bankman-Fried, the FTX CEO. And obviously, we all know what happened there. So it was announced back in December that Dan Berkovitz, the general counsel at the SEC, stepped down amid reports that he had met and dined with FTX founder Sam Bankman-Fried. In a recent announcement, the SEC said that Berkovitz is departing his role at the agency effective January 31st. Berkovitz was an ally of FTX within the financial regulatory agency and had meetings with Bankman-Fried and other crypto lobbyists. The outlet claimed that it has viewed emails that suggest the SEC official had a warm relationship with SBF, to say the least. And we actually saw here Michael Chamberlain, director of Protect the Public's Trust, saying if there was ever a scene to conjure up a vision of a DC rigged towards corrupt insiders at the expense of the little guy, it would be difficult to top this one. Not long before its collapse and a raft of fraud charges, SBF and his gang were wooing. In October of last year, the SEC and CFTC were discussing the best methods for regulating cryptocurrency. Bankman-Fried, FTX General Counsel Ryan Miller, and then FTX President Brett Harrison had met with Berkovitz at a luxury restaurant. The presence of Berkovitz at the dinner shows SBF's efforts to influence lawmakers and regulators. And we have also seen a lot of people hypothesize that there are some connections between Gary Gensler and Caroline Ellison's dad. Caroline Ellison was the CEO of Alameda Research, who was pretty much caught up in sort of like this entanglement of funds with FTX. So here it says Caroline Ellison's father, Glenn Ellison, is the head of economics department at the Massachusetts Institute of Technology. Where is it here? Yeah, so the AP reported that Ellison formerly worked with Gary Gensler when the now SEC chairman taught at MIT. So he taught at MIT as a former economics professor, and they're saying that it's likely Gensler reported to Ellison, who was the department's head. Now, once again, we cannot actually confirm this to be true, but the fact that he was in fact a head of economics department at MIT, and this is where Gary Gensler was a professor, it can definitely lead you to believe that there could have been some sort of relationship between the two. But just the fact alone that we saw people sitting on the SEC board going out for dinner with Sam Bankman-Fried months before the collapse of the exchange shows you that clearly they are not to be trusted, and clearly they have no idea what they are doing, as they let what Sam Bankman-Fried was doing go right under the table, and they waited until after billions of dollars were wiped out of customer funds to actually go ahead and lay charges on him. So thank you, SEC, so much for protecting investors like you always claim you're trying to do. Now we're going to move on here. That is all we got for the Binance and FTX news. We're going to hop into the Silvergate Bank news here now. And this is the largest crypto bank that does serve over 750 cryptocurrency exchanges, or rather they did, although a lot of their partners have been pulling out after it was announced last week that they were concerned about their ability to continue operating over the next year. And following this announcement, they did actually close their Silvergate exchange network. This is a big deal as SEN enables their digital currency and institutional investor clients to send USD 24/7 between their Silvergate accounts and the accounts of other Silvergate clients, effectively meaning that all these centralized exchanges who do their deposits and withdrawals through the Silvergate Bank are unable to do this now, as SEN has in fact been disabled based on the risk assessment from the bank themselves. And by the risk assessment, I assume this means based on the fact that they don't even know if they're going to be able to continue operating. And this is big because they did used to have over 750 centralized exchanges actually using them as a preferred banking partner. And we've already kind of seen the ripple effects of this, as we have seen in multiple companies, including Coinbase, Paxos, Galaxy Digital, Gemini, Bitstamp, Crypto.com, and Circle, all issuing statements saying they have cut ties with this banking partner. MicroStrategy and Tether also address concerns for their Silvergate connections, basically saying that they will not lose any meaningful money if the bank bank does go under effectively. So we already begin to see the ripple effects of this happening, as well as one exchange that was burned by this was Bybit. They did go ahead and halt deposits via USD bank transfers, citing the partner service outages. So it says here that effective immediately, USD deposits via wire transfer, so SWIFT and wire transfer for US banks, are no longer available. The block reached out to Bybit representative for further comments, but had not heard back by the time this article came out. Now, it is worth noting that although they have halted withdrawals and deposits via USD bank transfers, USD deposits via the crypto wallet AdvCash or credit card purchases of cryptocurrencies are still available on the exchange. Bybit said it will soon launch the AdvCash Wallet's withdrawal service, and that withdrawals via SWIFT or US bank wire transfers are available until March 10th at midnight UTC. So they said that USD assets held in Bybit are safe and secure, and previously they did roll out a system allowing their customers to verify crypto assets they are holding on the platform in their reserves. So they are not completely halting USD deposits and withdrawals, but simply have to reshuffle the way they are receiving and letting these funds go back out, as Silvergate has in fact gone ahead and shut down their exchange network. And this is not like a small exchange by any means. I mean, if we take a look at centralized exchange transparency, and then we account for the fact that Coinbase is not included on this list for whatever reason, and they would be in either number 1 or 2 spot. This is the 8th largest exchange according to DeFi Llama in terms of their assets under management, with $2.6 billion worth of customer assets. So effectively, this is not a small exchange by any means to be impacted by this. The ripple effect of Silvergate shutting down SCN is almost immediate, and I do hope that it does not have a big impact on any more of these exchanges, because the last thing we need is more FUD and more exchanges to melt down in 2023. But luckily, there is a way to protect yourself and ensure true ownership of your assets to make sure that you are safe even if centralized exchanges do collapse, through getting either a cold storage wallet or any sort of self-custodial wallet. And there are plenty of tutorials on YouTube to teach you how you can set these up and have safe and secure ownership of your crypto. So without further ado, I hope you guys did enjoy the content in today's video. You know what to do. If you made it all the way to the end, you are an absolute champion. Let me know in the YouTube comments down below and claim that champion status. I hope you are all having an amazing Monday. I'm wishing you all an amazing week ahead, and I hope to catch you in the next one. Peace out for now.